One of the best things about being in Canada is having super easy access to the US stock markets. But there are certain things that you must know and consider before you start investing your hard-earned money in the US markets. Today, let's explore some key factors to keep in mind when it comes to investing in US stocks while being in Canada. These factors might influence your decision when it comes to buying US stocks and ensure that your principal and gains are protected. So whether you're a beginner or an intermediate investor or simply a Canadian immigrant trying to navigate the investing landscape, this video is for you. Let's begin. Let's start with an overview of the two markets. The US stock market is the largest and the most liquid financial market globally. It stands at over $50 trillion. It has major exchanges like the New York Stock Exchange and Nasdaq, which are home to some of the biggest companies across various sectors, including technology giants like Apple, Google, Amazon, you name it. The market size and the diversity offer investors a broad spectrum of opportunities. The US market is also known for its growth stocks and has been largely considered the benchmark for global equity performance, with the S&P 500 having an amazing history of returns over the last 100 years. In comparison, the Canadian stock market, though significant, is much smaller in size. The total market cap is around $3 trillion. It is centered around the Toronto Stock Exchange and is known for its concentration in the mining, energy, and financial sectors. Despite its smaller size, the Canadian market provides a stable environment and is home to international listings and exchange-traded products. It includes the S&P/TSX Composite Index, which tracks the performance of the largest companies on the exchange. So both sound great, but what are some factors that Canadians need to consider when investing? Let's look at some factors that ensure that you keep a robust approach and a balanced portfolio. Let's start with a basic consideration, that is market size and liquidity. As stated earlier, the US stock market is the largest in the world and offers very high liquidity with a ton of activity in the market. This is largely due to the presence of large corporations and high trading volume on major exchanges. TSX, Canada's primary stock exchange, offers reasonable liquidity, particularly for large cap stocks in sectors like finance, energy, and mining. However, some smaller or sector specific stocks may have lower liquidity. Now, because the US market is more liquid and more active, traders tend to prefer those markets compared to the Canadian market. Personally, I do find more swing trading opportunities in the US market. From a recommendation point of view, Canadian investors may find more opportunities in the US markets. However, as expected, when it comes to this factor, the balance is somewhere in the middle, with Canadians dabbling in both the markets. Now, let's say you're a dividend investor. What is better for you? In the US, there are plenty of dividend stocks that can offer pretty great income for investors. However, the average dividend yield of the S&P 500 is lower compared to the S&P/TSX Composite Index in Canada at 1.4% and 3% respectively. Despite this, US dividend stocks can be attractive for Canadian investors, especially those looking for diversification or those who think that the US economy will outperform Canada's. In Canada, the dividend paid by stocks is generally higher than in the US. This is due to the presence of strong sectors like banking and healthcare, which often offer reliable dividends. Companies like Manulife, TELUS, and TD Bank are some of Canada's favorite dividend stocks. Moreover, many of these Canadian high-yield stocks have performed well in the past years, providing both income and capital appreciation for investors. Given the higher than average dividend yield and the stability of key sectors, the Canadian markets may be more favorable to those investing in dividend stocks. Now let's move on to something more exciting but riskier than dividend stocks. Yes, growth stocks. In the US, growth stocks are often associated with large companies such as Tesla, Amazon, and Palantir. These companies are expected to grow at a rate higher than the market average, and their stocks often trade at high price to earnings ratios due to their expected future earnings. For instance, Tesla has seen significant growth since 2020. I know the stock hasn't done that well in the last 2 years, but early investors are very happy. A lot of us are also investors in huge companies like Amazon that still have a lot of growth ahead of them. Some are also investing in companies like CrowdStrike, Twilio, and Palantir. I have a bit of a bias towards the tech sector, but you can find growth companies in any sector. I always tell people the amazing story of Monster and how it has grown over the past few years. There are opportunities everywhere. When it comes to Canada, you can also find growth stocks, including in the technology sector. However, the performance of these stocks may be influenced by factors that are not as favorable as they are in the US. Let's take Shopify for example. It's a growth company in Canada. We have all seen it skyrocket in 2020 and 2021. While investors made a lot of gains, it's been down, and I do feel it gets less attention from investors as compared to other opportunities in the US. When it comes to recommendation, I do believe that US has far more growth stock opportunities when compared to Canada. Just make sure that you know of the risks associated with investing in growth stocks and consider diversifying your portfolio to mitigate massive drawdowns. But yes, growth opportunities are better in the US. Next, let's look at how taxation is a factor. When investing in US stocks as a Canadian, it's important to understand the tax implications on your investments. When you hold US stocks in different accounts in Canada, the tax implications can vary. Generally speaking, the growth of your investments have no specific tax implications whether you hold US or Canadian stocks. However, it can depend on what you hold. For instance, if you hold US dividend paying stocks in tax-free savings account or the newly introduced FHSA account, you will be subject to a 15% withholding tax on the dividends. This tax is not recoverable. However, if you hold these stocks in a registered retirement savings plan, the tax is 0% due to a tax treaty between Canada and the US. It's important to note that Canadian mutual funds and exchange traded funds that own US stocks are considered Canadian residents and are subject to 15% withholding tax too. If you own these in your RRSP, they will not qualify for the 0% withholding tax rate. The withholding tax applies to all accounts, including your trading accounts. The only ones that are exempt are your registered retirement accounts. Of course, if you own Canadian dividend stocks, you won't have to pay any taxes in your sheltered accounts, and you pay regular taxes when held outside these tax sheltered accounts. Given the tax implication, it is generally recommended that you hold US dividend paying stocks in your RRSP and not in your TFSA, FHSA, or any other account. However, if you're holding a US stock that does not pay any dividends and you only want price appreciation, you can hold it in any account. Generally speaking, non-dividend paying US stocks can be treated as Canadian stocks, but you might want to consider one factor that affects all US stocks, that is currency conversion. It is another crucial factor to consider when buying US stock. You need to consider exchange rate twice, once when you buy and once when you sell. Your profits might be impacted by the changes in the relative value of assets. Let's say you buy a US stock for $100 at a certain exchange rate. You would pay about 133 Canadian dollars for the stock. Now suppose you sell the stock later for $150 when the exchange rate is more in favor of the Canadian dollar. You would receive about 214 Canadian dollars. Even though the stock price increased by 50% in US dollars, your gain in Canadian dollars would be about 61% due to the change in the exchange rate. However, if the exchange rate had moved the other way, it could have reduced your gain. So when investing in US stocks, make sure you consider the impact of currency conversion. This is not so much to decide which stock to buy, but when to buy and when to sell in case you want to time the market or swing trade. The final factor, and probably the most important one, is performance. Over the past 50 years, the S&P 500 has returned an annualized average return of around 10%. This long-term performance showcases the strength of the market and has actually remained around 10% for all of its existence. How does our domestic market compare to this? Surprisingly, over the last many decades, the average returns are quite comparable. However, if we look at just the last 10 years, the S&P 500 returns are over 12% while TSX returns are around 8%. Does this indicate that the Canadian markets are slowing down? This answer is debatable, and we'll have to wait and watch where the Canadian companies are headed, especially those in the oil and gas industries. We'll also have to see what happens to the growth of the companies if the economy slows down further. Given all these factors and the historical performance of the US and Canadian markets, it's quite obvious that we must all maintain a mix of both. Let's see what the experts have to say. Firstly, I would like to say that optimal allocation can vary depending on individual financial goals, risk tolerance, and investment horizon. However, here are some recommendations. Vanguard suggests that Canadian investors should allocate 30% of their equity portfolio to Canadian stocks and 70% to international equities, which would include US stocks. This recommendation is based on historical evidence on minimizing volatility and other factors. Northern Trust, on the other hand, suggests to minimize equity volatility, a Canadian investor should consider an 80% allocation to foreign equities, which would again include US stocks. Personally, I have a bit more bias towards the US markets because I'm relatively young and I'm willing to take on a little extra risk. That's where all my favorite growth stocks are. But as everyone says, having a big portion of your investment in the S&P 500 is likely to beat most fund managers and most stock picking endeavors. However, if you really want to mix it up, make sure to consider the US markets and definitely use the opportunity to invest in some of those growth companies. Let's look at some good companies and opportunities in the upcoming videos. For now, that's all. Always remember to keep learning and stay on top of your finances. Until next time.